Are you worried about your spouse or family's financial security after you are gone? Or maybe you are thinking about protecting your wealth and legacy. Then life insurance is a must. By the time you reach your 50s, your financial life is probably more complicated than ever. Maybe you are still paying off a mortgage, helping kids with college, or even supporting aging parents. On top of that, you're probably thinking about retirement and what kind of legacy you want to leave. Life insurance in your 50s isn't just about covering debts. It's about protecting your legacy and ensuring your family can maintain financial stability and achieve long-term goals even if you are not there to provide for them. The reality is, life is unpredictable. What happens if something were to happen to you unexpectedly? Would your spouse be able to pay the bills? Could your kids finish their education? These are tough questions, but answering them can give you clarity on how much coverage you actually need. If you don't have enough, you risk jeopardizing your family's financial stability and everything you work so hard for. And if you have too much, you're probably wasting money on coverage you don't really need. When I review life insurance policies with new clients, I often find that most people don't even know how they ended up with their current coverage. It's usually based on a random number that seemed reasonable at the time, or the minimal coverage they got through their employer. None of these approaches really work. In this video, I'll share with you a simple method to calculate your life insurance needs accurately. No more guessing. This method is more personalized and one of the most commonly used ways to estimate life insurance needs. The needs-based method. Rather than looking at your income, it focuses on specific expenses your family would need to cover if you were no longer around. Think of things like paying off debts, funding college, covering living expenses, and achieving future financial goals. There are two helpful frameworks within this method: DIME and LIFE. The DIME method stands for debt, income, mortgage, and education. And the LIFE method stands for liabilities, income, for final expenses, and education. While both frameworks are useful, I personally prefer the LIFE method because it's more comprehensive and better accounts for final expenses, which are often overlooked but can be a significant cost. Additionally, it simplifies the calculation by grouping debt and mortgage together as liabilities, because at the end of the day, both are obligations your family would need to handle. This streamlined approach makes the LIFE method not only practical but also comprehensive. Let's break the LIFE method down. First, we have liabilities. These include any outstanding debts, such as a mortgage, car loans, or credit card balances. If you pass away, these debts could fall on your family. Life insurance can help pay them off, freeing your loved ones from financial stress during an already difficult time. Let's assume your total liabilities equal to $270,000. So we have liabilities equal to $270,000. Mortgage of $250,000 and a car loan of $20,000. So this is our liabilities equal to $270,000. Next is income replacement. This ensures your family can maintain their current lifestyle if your income is no longer available. If your family relies on $150,000 of your income annually and you want to provide support for 10 years, you would need $1.5 million just for this category. This part of the calculation is about creating financial stability for your loved ones. So income, the family relies on $150,000 and we need to replace this income for 10 years, equals $1.5 million. Then there are final expenses, which cover the cost of things like funerals, medical bills, estate administration costs, estate taxes, and other end-of-life expenses. These can quickly add up, so let's assume $30,000 for those. Including this in your calculation prevents your family from having to dig into savings and take on debt to handle these costs. So we're gonna say final expenses equal to $30,000. Finally, there is education. If you have children, this ensures their future educational needs are met. For example, if you plan to allocate $100,000 for each of your two children's college tuition, that's another $200,000 to your total insurance need. So I'm gonna add education, $200,000, which is $100,000 per child. When we add all it up, we're gonna end up with the total life insurance coverage of, let me see, so we have liabilities 270, final expenses 30 is 300, 1.8. So we're gonna end up with $2 million life insurance need. This ensures your family can pay off debts, replace your income for 10 years, cover final expenses, and fund your kids' education. While it's thorough, it also gives you the flexibility to tailor your policy to your unique family situation, making it an excellent tool for personalized planning. The next vital step is to account for your existing financial resources before locking in a policy. Ignoring these resources could lead to being overinsured, meaning you would be paying for more coverage than you need, which could put unnecessary pressure on your budget. So let's adjust our $2 million life insurance need for our existing financial resources. Existing financial resources. So let's assume that you have $100,000 in cash savings. Cash. Let's also assume that you have $200,000 fully paid off rental property. $200K rental. And let's assume, for the sake of simplicity, that you also have $200,000 group term life insurance through your employer. So $200K group term life. So if we add it all up, we're going to end up with $500,000 in existing financial resources. Now what we need to do is that we need to subtract this $500,000, these existing resources, from previously calculated life insurance needs. So we recall that we calculated we need $2 million in life insurance. And if we adjust this for $500,000 in existing financial resources, we're going to end up with a new life insurance need of $1.5 million instead of $2 million that we calculated previously. This adjustment ensures your policy still fully protects your family while saving you money on premiums. Life insurance in your 50s isn't just a safety net, it's a plan for peace of mind. It ensures your family is protected, your debts are covered, and your legacy is secure. By taking the time to calculate your needs and tailor your coverage, you can avoid overpaying for unnecessary insurance or leaving your loved ones unprotected. If you are feeling unsure about where to start, you're not alone. Estimating the right life insurance amount can feel overwhelming, but with the right guidance, it's a decision you can approach with confidence. If you need our help with ensuring your life insurance aligns with your goals and provides peace of mind for years to come, please feel free to reach out. That's all for today. If you like this video, please give it a thumbs up and subscribe to my channel. Thanks for watching.